WP Carey stock, ticker symbol WPC. This stock is down almost 9% on the year-to-date chart, while the overall market, in this case the S&P 500, is up roughly 8%. So that's a big difference. Is this stock undervalued and time to load the boat, or is this REIT still overvalued? On the 28th of April, WPC presented quarter results where they beat on FFO and revenue, so that's pretty good. Next to that, they also raised the dividends, which is very nice. And from a dividend point of view, things look pretty interesting, with dividend yields sitting at almost 6%. But does this mean that WPC stock is a buy at current prices? Well, in this video I'm going to show you real quickly what WPC does. The most recent earnings report, the fundamental analysis, dividends, returns versus the S&P 500, comparison versus major competitors, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. WP Carey is a real estate investment trust that invests in properties leased to single tenants via triple-N leases. The portfolio is primarily comprised of single tenant office, industrial warehouse and retail facilities located around the world. If we dive in the most recent earnings report, we see that revenue is up 22% year over year, which is very nice. There were some things that had a big impact on these revenue increases, such as the lease revenues that were higher and a stronger dollar, to name a few. Net income was up 87%, which is also a great number, but again, which increased due to a gain on the sale of a real estate of 176.2 million. And now one of the most important numbers, the AFFO, or adjusted funds from operations. It was reported at $1.31 per share, down 3% year over year. And to me, this does not look good. Dividends were increased to $1.06 per share, resulting in a payout ratio of 81% based on the current AFFO. The average for REITs is around 75%, so this looks pretty okay in my opinion. The 2023 full year guidance is expected to be in a range of $5.3 to $5.4 per share. WP Carey received over 99% of the contractual base rent with an occupancy rate of 99.2%, which looks really good to me. The portfolio consists of 1,446 properties leased to 397 tenants, with a weighted average lease term, also called a WALT, of 10.9 years, which is pretty okay. If we check the property type breakdown, we see that industrial represents 27% of the total ABR, while representing almost 37% of the total square feet. Warehouse is the second biggest segment with 24% share in ABR, while sitting at 36% square feet. Both retail and office are sitting at 17% share of the total ABR. And self-storage is the smallest segment with only 4.5% of the ABR. To me, this looks pretty well diversified, especially since this company was focused on office buildings historically. And this industry was of course highly impacted by the lockdown periods and how companies are operating after these lockdown periods, with working from home. So it's pretty good to see that they are shifting their focus on other industries right now. In here we see the top 10 tenant breakdown, representing 18.6% of the total ABR. So again, well diversified. The top tenant represents only 2.7%, but the lease term is only 1 more year, so definitely keep an eye on that one. Another interesting thing to see is the same store growth. Industrial and retail are the two segments that are growing the most right now. And Europe is also growing at 6.5% year over year, while US is only growing at 3%. The last thing that I want to check is the net debt to EBITDA. This number is sitting at 5.8, which is really great. I prefer a number in the range of 5 to 6.5, so this comforts me a lot. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. WPC is a 15.39 billion market cap company. PE ratio isn't a fair metric to use with REITs, so I will be using the price to FFO instead. Right now it's sitting at 12.18, indicating that they might be undervalued. Later in this video I will show you my 3 price targets for WPC, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 1.56 billion, and in this graph we see that the revenue went up and down quite a bit in the past couple of years. However, most recently it is only increasing, so that's the good part. The margins are pretty much the same story. It's going up and down quite a bit historically, but ever since 2020 we see increasing margins, so that's very nice. We see interesting things happening at the analysis estimations. In 2023 it's expected to see a decline of almost 8% in EPS, but from 2024 we see mid-single digit growth numbers. With the revenue estimations we see almost 15% growth expecting in 2023 and 7.5% growth in 2024. Return on assets is sitting at 4.8%, which is below my 10% minimum. But for REITs it's pretty decent. Return on equity looks steady at 8.5%. And the most important number, return on invested capital, is sitting at 2.6%, which is not the highest of course. Next to that, it's at the same level as the 5-year average. Current ratio is at 0.11, which is really low, maybe even too low. I prefer a range of 0.5 to 2, but this can be way different depending on the type of company. Total debt is sitting at 8.2 million, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now total cash is sitting at 149 million, so they can't pay down a big chunk of their total debt, which is something that I don't like. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And in here we see that free cash flow is going up over a longer period of time. However, most recently numbers don't look that great, so keep an eye on this one as well. Another thing that I think is very interesting about this company are the shares outstanding. It's going up in the long run, but it's pretty common for a REIT, since they issue new shares to raise capital and grow the business. Next up are the dividends. Dividend yield is sitting at almost 6%, which is a great number of course. Annual payout is at $4.27 and payout ratio is at 80%, as we saw earlier in this video, and not the 119% displayed here. The average for REITs is around 75%, so this 80% is not too bad. The 5-year growth rate is at 1% and there is no dividend growth streak. But to be honest, I don't mind that much, since dividend yield is already at almost 6%. Overall these dividends look pretty good to me, but how about the historical returns? I decided to compare WPC stock with the overall market, in this case the S&P 500. Next to that I added 2 competitors, EPRT and BNL. On the 5-year chart we see that WPC returned 44% including dividends, underperforming the S&P 500 big time, which returned 65%. EPRT crushed the S&P 500 with 128% return, and BNL had the lowest return with only 13%. On the 1-year chart it looks pretty interesting. WPC returned minus 4.6% and again underperforming the S&P 500, which returned 6.7%. But EPRT had again the highest return with 17.5%. On the 6-month chart it's pretty much the same story. WPC is at minus 6%, while the S&P 500 is at 4.2%. And again EPRT had the highest return with 14.6%. On the 1-month chart it's again EPRT with the highest return. WPC had again one of the lowest returns. So bottom line, WPC was beaten by the S&P 500 big time, in the short run but also in the long run. But how about some fundamentals compared to the other companies in this list? we see that these three companies are quite different in market cap and enterprise value. Revenue growth year over year is the highest at EPRT, but WPC is not too far. The 5-year growth rate is the highest at EPRT and is at only 12% at WPC, which is way lower than these two competitors. The net income compound annual growth rate is also the highest at EPRT. Last but not least is the free cash flow compound annual growth rate. EPRT is again the winner here. Both WPC and EPRT have the highest gross profit margin. Net income margin is the highest at EPRT, but WPC is not too far. Free cash flow margin is the highest at EPRT. Return on total capital is nearly the same number for all these three companies. And all companies have quite some debt compared to the current cash position, so no big winner here. The last thing that I want to check are the dividends. BNL has the highest dividend yield, but no growth in dividends. WPC has the highest dividend compound annual growth rate. And to me, there's no big winner here. Overall, I think WPC was underperforming the companies in this list, especially EPRT. But could WPC stock still be a buy at current numbers? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with the revenue growth. For the revenue growth, I'm filling in 5%, 7% and 9%, since I think they will increase their revenue at the same numbers versus the historical averages. Next to that, it's also based on the analysis expectations and the current outlook. Profit margin, I'm filling in 45, 48 and 51%. And for the free cash flow margin, I'm filling in 60, 63 and 66%. For the PE ratio, I'm filling in 20. And for the price to free cash flow, I'm filling in 15, 16 and 17. It's a slow growing company and not all fundamentals look that great, so I don't want to overpay for the growth, and there's no big moat or anything. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I take 12.5%, but with this company I want to be a bit more conservative. Right now WPC stock is at $71. I hit analyze and we see a few green numbers. And since this is a REIT, I will only focus on the discounted cash flow value and not the multiple of earnings value. We have a low price target of $54, a mid price target of $67 and a high price target of $84. To me, this mid to high price target is the most justified, indicating that they are undervalued based on these numbers. My final conclusion on this company is that I really like to see the shift in terms of industry focus. They used to focus on office buildings, but the other segments are growing at a higher pace. There are of course some things that I don't like about this company, and one of them being the free cash flow and margins that are going up and down quite a bit. Overall, I think you got a great dividend income stock with WP Carey, and right now they seem slightly undervalued with a $84 potential. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and that it brings some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.